we're ready to go live.
Yeah, you can see the slides, Fed behind the curve. Can you see me?
Yes, I can see you fine.
Okay, excellent.
Okay, Haseeb, thank you for joining. My name is Ifty Islam. I'm the CEO of Pathfinder, also the chairman of AT Capital Infinity Technology. And today I'm joined by Haseeb Ahmed, who's a senior portfolio manager at Millenium Partners, which is a hedge fund in New York. He trades particularly rates markets globally. And prior to Millenium, he had his own fund. And before that, he was also a senior US economist at JP Morgan. Today, we will be discussing, I think, the main topic on everybody's minds in global markets, which is, is the Fed too complacent? Is the Fed behind the curve on inflation? Could there be an inflation shock that's going to destabilize financial markets? We've had a little bit of a taste of that. I think if the Fed and other central banks around the world get the inflation call wrong, either they will raise rates too late, and there could be a major 2008 type financial crash, or they could raise rates prematurely and they could choke off a very nascent post-COVID recovery. So what we'll do is we will be going through a few slides, and Haseeb will be commenting on some of the slides as we talk, and then Haseeb and I will have a discussion. At the end of today's call, which will, I think the whole call lasts around 30 minutes, we will allow Q&A from the audience. So if anybody is watching on Facebook Live, if you post any questions that you have for Haseeb on Facebook Live, then we will collect all the questions at the end and try and have the last 10 minutes of Q&A. So let's start. In terms of the key issues, I think the Fed is really, the Fed and other central banks, but particularly the Fed, is facing a major dilemma. Inflation is overshooting its 2% target, is increasing, not just in terms of the headline statistics, but there's lots of anecdotal evidence of inflationary pressures and supply bottlenecks in many areas of the economy. We're seeing also global commodity prices going up as well. And I think that one of the challenges that we mentioned for the Fed is, do they apply the brakes gently? Do they wait and see? So that the Fed is moving from a preemptive monetary policy to a reactive monetary policy. That could be quite risky. And I think another challenge for central banks around the world is that there may be some structural factors which are also pushing inflation up. So beyond the massive monetary and fiscal stimulus to respond to COVID, there are also structural factors such as demographics, reduced globalization, which may also be increasing inflation structurally, or at least reversing the benefits we've been seeing in the last 2 decades in terms of globalization and integration of China into global manufacturing. We know there's massive amounts of liquidity currently in the system. In March and April of last year, governments allocated about $10 trillion in just 2 months, which was 10 times the fiscal stimulus of the 2008-2009 crisis. And we mentioned before, I mean, the most recent warning for, or let's say, risks of central bank complacency is the 2013 taper tantrum, where even a hint from a small reduction in quantitative easing by the Fed at that time caused a massive sell-off in global financial markets, with emerging markets being, suffered particularly badly. So you can see in terms of the headline inflation numbers themselves, you can see on the red line, the US is seeing the biggest jump in inflation. The Eurozone is following. Really only Japan is still in deflation. This next slide shows 5-year swap rates. For those who are not in the financial markets, swap rates are very similar to 5-year bond yields. So it's 5-year long-term interest rates. And 5-year interest rates have been going up sharply in both the US and Eurozone, off their lows that we saw last year, in the immediate response to COVID. And this next slide shows, I mean, although bond yields are going up in the US, by historic standards, bond yields are still, this is 10-year bond yields, are still extremely low. So if one says, yes, they've gone up a lot, could they go up a lot more? Yes, they can go up a lot more. If you look at this chart, bond yields are still, let's say secularly in terms of the long-term trend, are still very low. Will they stay low? Will they revert back to let's say historic norms or means? Again, this chart shows it shows a more detailed focus on CPI. There were some factors, particularly energy prices. So what economists tend to focus on is core PCE, which is a let's say a smooth measure of inflation, and that has been going up a lot less than we expected. So and we can see here commodity prices have also gone up, but not, I mean, at least in terms of the overall commodity complex, it's not yet exploded, but we're seeing quite a significant rise. And again, if you look at historic norms, if you look after the 2008-2009 crash, you could see a potentially a much larger rise in inflation. This next slide shows break-even inflation or inflationary expectations, which have gone up quite sharply. So financial markets are expecting inflation to go up, and the question is, could break-even inflation? So the break-even inflation rate is the gap between nominal bond yields and those TIPS or Treasury inflation protection securities, and again is probably the most accurate measure of the market's expectations about inflation, and they're both going up quite sharply. So I think the next slide show, which is interesting, this is from some work done by the Financial Times. It shows that if you look at the 30-year trend of inflation, actually the 50-year trend of inflation, we had these inflation shocks in the 1970s, and in the 1980s, Paul Volcker, the former Fed chairman, tightened monetary policy very aggressively, and inflation has gone down sharply, and certainly in the last 10, 15, 20 years has remained relatively subdued. So central bankers today are not really used to living in a world of high inflation. So high inflation is quite a distant memory, and that may also feed some degree of complacency. You can see in the 2010 to 2015 period, there was bouts of deflation or disinflation, most notably Japan. And this again shows just how low short-term interest rates are. So if you look at policy rates, US, Japan, and Eurozone rates, Japan and Eurozone rates are negative. US rates are pretty much at zero. And again, there's a lot of discussion about whether rates are too low and what central banks should do. So I think with that, let me bring Haseeb into the discussion, and we can perhaps start the discussion about inflation itself. I'll come back to some more slides, but Haseeb, do you think this jump in inflation is a real concern? Should it be a concern for financial markets? Do you think the Fed is over-relaxed? I know there's a lot of different questions, but what is your response to both the current level of inflation? Is it one-off, and also is the Fed's relaxed stance appropriate? Maybe would be forced to reverse very quickly. Haseeb.
Yeah. Well, first of all, thank you for inviting me. Very happy to be here. This is obviously a topic on everybody's mind now, and it's a confusing topic. I mean, I think your chart, which shows that 30-year inflation trend, says it all. It's important to keep in mind that coming into this period, most central banks were actually trying to raise inflation, right? So we've had, for the last 10 years or so, very disappointingly low inflation outcomes. You don't want inflation to be zero. Most central banks want inflation stuck somewhere around 2% or so. And we've underperformed that. So coming into this period, there was certainly no real concern about upside inflation risks. Most of the concerns, and this goes to pre-COVID, was really about downside. Having said that, so naturally that environment would breed a bit of comfort, complacency, however you want to call it, on any sort of market acceleration on the upside. And when you overlay on that a bunch of things that's happened this year, you already pointed to fiscal stimulus, which is record. It's actually I think it's a record high since the Second World War. We've had supply chain issues, bottlenecks. We've had a bunch of production shocks and so on. It's not altogether surprising that we've had a huge spike. What I think will start to get concerning is I think you presented a couple of charts showing 5-year inflation swaps. There are a couple more that you didn't show, but if you look at, for instance, consumer surveys, those have also seen a slight uptick in inflation expectations. Typically, the way this works is you get these short-term spikes in inflation in either direction, but as long as those expectations don't move outside their usual ranges, central bankers can rightly look past these short-term shocks. So the way to think about this, I think, going forward is what's the path of those expectations going to be, both the consumer-based expectations as well as the swap rates and break-even rates that you showed. I think if you see those things breaking out on the upside, you will see concern from central bankers.
Right. So I think that I think that the challenge, as I said, when we come back to a few of the slides, if I just share the slides again. So interest rates are very low, and this is the cumulative. This is some slides from McKinsey. This shows the economic stimulus as a percentage of GDP. The blue bubbles show the post-COVID response, and the dark blue or the black bubbles show the 2008 crisis. You can just see the scale of the stimulus is pretty massive, right?
Yeah. No, it's extraordinary. There's no question about that. It's the largest in Second World War. In some cases, might even be the largest ever. There's no question about that. And those are the reasons why you want to be a little bit. You don't want to be complacent. You want to be watchful for sure. But do you want to act? It's not clear because historically, there are a lot of strong underlying disinflationary forces still in the system, technology being the most important. I do think, though, that I want to come back to the topic of inflation expectations and just mention one thing, which is that typically these price shocks become permanent if two things happen. One, those expectations start to move higher, as in break out of ranges. And second, wage inflation needs to pick up as well. We have seen some uptick in wage inflation. It's early days, it's all of this is we're really just talking about the past quarter or so, maybe 2 quarters. We are beginning to see some acceleration in wage inflation in the US, but it's still fairly modest. And I think those are things that one would want to watch very carefully. Certainly, I would submit that this is probably the watchfulness that's required now is probably more so than at any point in the last 25 years of inflation history.
Yeah, and I think if we just go back to some of the, in terms of some of the, not just stimulus. So the next slide is, it was very interesting. So Milton Friedman has something to say about this explosion. So we look at the explosion in money supply growth. It's pretty extraordinary just how dramatic the rise in liquidity, money supply growth is. And normally that scale of liquidity expansion would be extremely worrisome for central banks. But in this this current COVID crisis macro world, central banks seem to be still relatively relaxed about this massive amount of liquidity.
Well, if you really will have to change their mandate to include asset prices for them to get too concerned about this, right? Because what's happening is a lot of this liquidity is just showing up in asset prices. In fact, look at that chart. It's essentially been trending up pretty sharply since 2000, right? And of course, then you see this kink right after COVID. There's no question that some of this will feed through to price inflation, but a lot of it is just showing up in asset prices, right? Look at the path of the equity market since COVID. That says it all, or credit spreads, or, what have you.
Or Tesla stock or Bitcoin.
Tesla or Bitcoin.
Yeah. So I think some of the let's say if we look at barometers or benchmarks of irrational, if not irrational exuberance, let's call it excess liquidity exuberance, I would say that there are areas of the technology sector and particularly crypto where the scale of price gains is kind of a leveraged reflection of excess liquidity.
I thought you were going to say AMC. You know, it's up like what 300% in the last few days.
Yeah, I guess so. AMC is also interesting. AMC is the Reddit the Reddit the anti-short Reddit crowd, I guess you could say. So I mean, GameStop and then now AMC. So squeezing hedge funds, or this battle between retail investors and hedge funds, which is also an interesting, I think, in terms of macro risk. That's also very interesting because if you think about the let's say systemic risks in the financial system, I think that the this massive liquidity is definitely the primary focus is inflation risk, but the risk on individuals' balance sheets of excessive trading and speculation in crypto and in pushing up GameStop and Reddit is very real as well. And if we get an abrupt collapse in financial markets, I think we got a bit of a taste of that when Bitcoin came off from $60,000 to mid $30,000 initially on Elon Musk's comments about the electricity consumption from Bitcoin, or let's say the non-green credentials of Bitcoin, and then after that the Chinese authorities cracked down on Bitcoin mining. That degree, that scale of Bitcoin sell-off began to filter through to both rising volatility and also a reduced risk appetite in other markets. But that was just really, I think, a very small taste. If that was a much more protracted sell-off, then I think there's a lot of new investors in not just Bitcoin, but in the financial sector who were sitting at home during the crisis, got a lot of liquidity and COVID stimulus checks, didn't know what to do with them, and very successfully made a lot of money buying Tesla and going up 6 times, or Bitcoin going from 6,000 to 60,000. And again, many of these investors haven't really experienced, are new investors in markets, and probably don't have a lot of experience in risk management. So that's also another, I'd say, systemic risk in the system.
Yeah, no, 100%. And it's not just equities. I mean, look at places like Canada and Sweden or Australia, and look at real estate prices, or price to income ratios for homes in some of these countries. Liquidity has entered some very tricky places, and I do think there's evidence of froth across asset classes. And I agree with you that is a potential systematic risk, and it's also not one for which there are any easy solutions or fixes. So
it comes back to a similar, I guess, challenge for central banks, which is that in taking the froth off or putting the brakes on, or as it was one of the former Fed chairmen who said, I don't know whether it was Volcker, but it was taking the punch bowl away when the party just gets going, or words to that effect.
Yeah, that was Volcker. No other central banker after Volcker actually believed that, but that's my view of central banking. We'll keep that up.
But I think the challenge again there is allowing this. First, you have systemic risk. I would say another, let's say, important consequence, you could say side effect, but a significant one, of this exuberance and excess liquidity in financial markets is massive increase in income inequality. And I think that Biden is beginning to address that with his $1.9 trillion fiscal stimulus, although that, of course, is potentially adding to the problem of excess liquidity. But I think a world where Jeff Bezos or Bernard Arnault is worth $180 billion plus, and vast segments of the global economy are struggling to feed themselves. Even in countries like the UK or the US, I mean, there's a significant segments of society. So I think that the monetary and fiscal policy is not only taking risks with inflation, but you could argue that monetary and fiscal policy is fueling a lot of a political time bomb, which may manifest itself in unpredictable ways.
Yeah, no, I completely agree with that. I mean, if you go back to your liquidity chart, what's really happened is it used to be, 30 years ago, and of course, I'm just making some numbers up here to illustrate a broader point, maybe 80% of that was going into price inflation, and the remaining 20% into, when I say price inflation here, I mean goods and services, then maybe the remaining 20% asset prices. What's really happened in the last, 15 years or so, is that ratio is reversed in the sense that the vast majority of that liquidity has gone into asset prices, and the rest, maybe a relatively small percentage, if any, into price and consumer price inflation, and that has clear ramifications for some of the issues you just mentioned, right? Inequality and so on. I don't think this is a central banker's problem, though. In fact, it's not clear that they have the tools to address this. I mean, what are they really going to do? Stop providing liquidity? That's not a solution, right? When there's a crisis or there's some sort of economic slowdown. So this requires some sort of coordination, probably, between fiscal and monetary. And to be fair, we're seeing that now, right? This is a problem that policymakers have recognized around the globe. And we are seeing that sort of coordination for the first time.
I think that's right. So I think the Biden administration, not just through a fiscal stimulus, but the general push towards wealth taxes right. Come back. But wealth taxes and wealth redistribution, again, may cause a potential major pullback or a crash in equity prices. If not on its own, there was nervousness when there was a focus on rising corporate and personal and wealth taxation. So that'll be interesting to see how that plays out. But I mean, prior to the last, not to digress off the core topic of central banks inflation, but prior to the US election, we saw the attack on the Capitol and many other, let's say, bubbling under the surface in Europe, even in the UK, the anti-COVID protests, I think, have a political element to it as well. And you're right to say it should be fiscal redistribution, but again, it's a consequence of this this unprecedented massive liquidity injection, disproportionately benefiting the richer segments of society. And actually people with assets, whether it's real estate or stocks, obviously Bitcoin or Tesla stock do particularly well, but any stocks, anybody with assets is doing very well in the world of excess liquidity. But we often take our eyes off the fact that the majority of at least the global population, and even in developed countries, the majority of the population aren't all asset rich. And I think that the positive trend has been lower inflation. The other secular trend, which has been extremely negative, is a massive increase in income and wealth inequality, which has accelerated dramatically during COVID. So that's something else I think that again is maybe not in the central, I wouldn't say central bankers' minds, but maybe in the political discussion, it's becoming.
Well, I think it's on central bankers. I think it's on central bankers' minds as well. It's not clear they have the tools to do much about it, though.
Yeah.
Right. So I mean,
sorry, go ahead, Haseeb.
No, go on.
Yeah, I was saying. So I've just got a few more. I mean, I found this was an interesting chart about car and truck prices in the US. Yeah. And I mean, I think one of the things. I mean, I'm probably, as you're sensing, I'm a bit more of an inflation hawk. On the hawk versus dovish, or let's say I'm a bit more concerned that central banks will end 2021, realizing that they've raised rates too late, and there could be a major bond and stock market sell-off on that. But I mean, there's a lot of localized evidence of it, it's not just a liquidity phenomenon. So you're seeing supply dislocations and a lot of liquidity, meaning that there's a lot of demand, leading to these very extreme moves. I mean, this is an interesting article in the FT about how used car prices in the US are going out of control. I mean, in some used cars would have sold for $3,500 before COVID, and they're now selling for $8,000. I mean, yeah, I know used cars may not be representative of the broad economy, but it's quite interesting.
And this, you haven't yet seen the full thrust of the reopening upward pressures on things like airfares and hotels and so on. The used car phenomena there has been obviously driving some of the upside in inflation, and that may well ease off. That has to do with chip shortages, which are leading to cutbacks in new car production and so on. Whatever the reason, that's probably going to ease off. But you're right that there are other things such as airlines and if we want to get into the details of inflation, we could, but there's just a lot of other stuff that's yet to see the full thrust of the the reopening, the post-COVID upward pressures. I think these are certainly, I would agree with you that we're probably going to end the year somewhere around 3.5% to 4% inflation, which is a remarkable number. And we're talking about core inflation here, as in stripping out the food and energy components, which historically have been quite volatile. So in other words, the most stable part of inflation, core, is probably going to end up nearly twice above what historically has been the central bank's target, the Fed's target. But the key issue is whether it's, I mean, this chart says it all, right? Like the key issue is whether it's transitory or not. And that's a difficult call to make. I mean, central bankers do have a trade-off. It's, we've talked mostly about inflation, but in the US at least, and this is not true in other countries, but in the US at least, we're still about 8 to 10 million jobs away from where the path would be had there been no COVID. We're yet to recover 8 million jobs that were lost. And then overlay on that, the new jobs that might have been created had there been no COVID, there's a huge shortfall, right? So it's the first time in my career I'm seeing potentially a genuine trade-off that central bankers are facing between the two mandates, employment and inflation.
Yeah, I think that what's also, I mean, sorry, I'm just going to interject and remind anybody of the audience that's watching on Facebook Live that if you can start posting any questions you have for Haseeb, because we have to finish up in the next 15 minutes or so. I think if you post them on Facebook Live, then we'll try and address as many as we can. So please do start posting your questions or your comments. Yeah, I think the thing about this chart is also the wealth redistribution imperative is also potentially going to add to the inflation challenges.
Oh, sure.
Because if you continue to have massive fiscal stimulus and direct checks and cash to the less well-off in society, that can also add to inflation risk. This next chart shows fiscal support announced since December 2020 and the cumulative. So you can just see the scale in the US of Biden's fiscal stimulus proposals. So really, it's the US as the outlier compared to Euroland and Japan. And the next on the side on the right shows some forecasts on the economic impact of Biden. Not surprisingly, the US is the primary beneficiary, but it's not clear that Biden will be able to, the Biden tax cuts will be able to pull the global economy or drive the global economic recovery. This next slide is also interesting. It shows it's the IMF's estimate of excess capacity or economic slack, the output gap, as economists call it, and it shows that the US is kind of using up capacity. So output gap in the US, which is the blue line, is disappearing. Again, this is a forecast, but you can see that the US is in a very different situation to Japan and the UK, and well, particularly the UK and Eurozone. So I think the inflation risks are likely to manifest itself much faster in the US. Would you agree with that, Haseeb?
Yeah, no, so there's something else. There's another interesting angle to that stimulus chart, especially in the context of this one. So one of the reasons, I just said a few minutes ago that we still have this huge labor market shortfall, right? And yet, as this chart correctly shows, there isn't much of an output gap left. In other words, we've pretty much made back all the GDP, the output that was lost during COVID. And the reason for that is that, and yet we haven't recovered the labor market losses. The reason for that is that the stimulus programs have been we don't know for sure, but one theory is that the stimulus programs have been creating disincentives for people to actually take jobs. So there is that angle as well here. And of course, that is also inflationary, right? Because it lifts wages and so on. But I agree with you that, again, look, the bottom line is you've had an unprecedented amount of stimulus at a time when we're recovering from a major shock that's led to supply bottlenecks, demand shortfalls as well, but also supply bottlenecks. So this is a rather toxic brew for inflation short term. And it may well be that it becomes more ingrained in people's psychology, and we have an environment akin to the, at least the late 80s and early 90s. I have a hard time seeing the 70s and early 80s where inflation in the US reached 10%. That I think is a difficult one for me to fathom right now, at least. But you could clearly see a situation where, instead of the 1.5 to 2 range we've been stuck in for the last 3 decades, you've moved up into, somewhere around the 3.5 range. That's a plausible outcome. And at that point, inflation proves sort of stubborn in the sense that it doesn't want to come down from those levels. And you do need a central banking response. That's a scenario I can completely envision.
Yeah, I just go through a couple more slides and we'll actually start moving on to some questions. So this is bulk shipping rates have gone up dramatically, the Baltic index, iron ore prices. Again, we mentioned inflation expectations. This is a much longer term chart of inflation expectations. It just shows how dramatically they've risen. The next slide is from a piece from Bank of America, which shows the number of mentions of inflation in company earnings calls. for equity analysts. So I think the equity markets are beginning to pay much more attention to inflation. And this next chart is from some work done by Charles Goodhart, professor at LSE and former chief economist at the Bank of England. And this is a very interesting angle, which he's talking about demographics and inflation. And he's making the point. So this chart here, the red line shows the labor force from the rest of the world. And the blue line shows the labor force for the globalized economies. Globalized economies is developed countries plus China. So the rapid aging of the Chinese population is going to see a major, although we've got a lot of surplus workers in countries like Bangladesh and elsewhere, in terms of the major manufacture, unless we can transition from China to Bangladesh, Vietnam, India, and so on, and Africa being the taking over from China as the manufacturing engine locomotive of the global economy, there's going to be more pressure there. And
yeah, that's a good chart.
Charles Goodhart's making the point that we're seeing this trend that could combine with COVID, the COVID stimulus, and everything that's happening with COVID, and lead to a structural long-term rise in inflationary pressures, which will reverse the disinflationary impact of China over the last 20 years. So that's quite interesting. This is a little bit, I mean, this last chart shows investors pulling back from frothy bits of the markets and non-profitable tech, I think this is from Goldman actually, non-profitable tech, liquid IPOs and Bitcoin sensitive stocks. So I think this was up till the beginning of May. Actually, if you extend it, it's gone down a little bit more, but it probably has a lot more further to go, particularly in Bitcoin sensitive stocks. So it's an interesting reflection of frothiness. This last chart, and then we'll maybe move on to questions because we're into the last 10 minutes of the segment. So this is a couple of slides. This slide shows so taper tantrum was, I think, around May of 2013, middle of 2013. So this shows the taper tantrum here. So you see how much bond yields went up in a very short period of time. In that period, then of course subsequently they fell again. And then you can see here some right hand side chart shows again. So there's a lot of bit messy, but rates here. Some work from Western Asset Management. Rates here going up dramatically in that 2013 period here. Here's the taper tantrum here. Oh, excuse me. And so that's really, I guess, the $64,000 question in financial markets is: could we see another? If the central banks do start raising interest rates, could we also see a taper tantrum? And I guess that's what central banks are trying to juggle. That there could be a very, and I think you could argue that maybe they're getting themselves into a corner. If you're being, a central bank skeptic, you say that they're kind of, setting themselves up for a beating, so to speak, in terms of getting themselves into a corner and then having to raise interest rates in response to a market sell-off, which could see a much more dramatic sell-off.
I mean, that's probably a reasonable probability scenario. If you look, I mean, I think the way central banks are approaching this is there are two states of the world, one where some of the issues we raised in this discussion come to fruition, and you're looking at stubbornly high inflation, and at which point they'll have to respond. And then there's another state of the world where some of the forces, globalization, technology, flexible labor markets, and so on, reassert themselves sometime next year, and we're back to at or under 2% inflation. In the latter world, their response will seem perfect, right? They're not really, they're sort of talking a little bit about upside risk to inflation, but not really doing anything about it. They're keeping their responses fairly tepid at this point, even in terms of communications, let alone actual actions. In the latter scenario, they will look silly, but at this point, not silly, but they'll certainly look behind, like they're behind the curve. But it's not clear they can do much about that right now, when we still have these other issues also, right? Labor market shortfalls, fragile economies. It's easy to forget we're still, in the United States, for instance, and in the US is one of the more open places, there's still large chunks of the economy that haven't fully reopened, right? So it's not clear
we're kind of, I mean, but we're in the UK, speaking in the UK, where the reopening is happening maybe a bit further behind. I guess the US and UK are probably reopening faster than the rest of the world, but in terms of relaxing lockdowns. But in the UK, we're seeing major labor shortages and upwards pressure in restaurant, hospitality.
I've seen that everywhere in the world.
Holidays. We're just seeing that there's such a crisis of labor. So we have this strange situation where the unemployed, there's still a massive amount of unemployment. We're actually seeing significant upwards price pressure in some segments of the economy. So it's difficult to judge that.
Yeah, a lot of that, of course, is because of these income support programs that government has put together, right? So the question is, the other thing, going back to the question of central banks, is they probably want to wait out the period when the income support programs start to get relaxed. In the US, for instance, the unemployment insurance schemes start phasing out in September. So they'll probably want to wait out to see if that leads to a response in labor supply. If not, I agree with you. By the way, the labor shortage issue is absolutely acute in the US. There are restaurants that can't, in New York, there are restaurants that can't reopen because they can't find workers.
Yeah, I think it's the same in the UK. Well, I think we're just into the last 5 minutes. So I'm going to, sure. I think another topic, but maybe for a future discussion, Haseeb, with you, will be on modern monetary theory, because I think one of the other interesting questions is there actually going to be, and I don't think we have time to address it today, but let's put it down for the next episode. But is there, is all these blank checks that are being written, or limitless money printing? Yeah. It seems that there's no cost and no consequence of having such massive, deficit and debt levels. And I think that may also come back to haunt us, but that's maybe something else. So I think there's a couple of questions now. I just wanted to finish in the last 5 minutes. Shahjahan Alam, who's in the UK, he's a member of Pathfinder, and he's actually works for an asset management company in the UK. He was asking, when do you think QE is going to unwind? What do you think in terms of return expectations? When you and what do you think from today into where would you allocate between equity bonds and cash? I think we can talk about that without too much sensitivity, but equity bonds and cash. Where do you think the best returns are going to be in the next 12 months? What do you think, Haseeb?
It's a tricky question. I mean, start with the first one, because obviously the second one is tied to the first one. I think the Fed's going to start signaling. First of all, this question, I presume it's related to the US, because some central banks have already started tapering or signaling taper, such as, the Bank of Canada and even the Bank of England has taken a somewhat hawkish stance recently. But as far as the Fed is concerned, I think Jackson Hole, which is in August, is probably when you get the first set of signals. I do think by the end of this year is probably a reasonable timeline to start thinking about taper issues. I think on the other question, I still think, obviously, last year and was exceptional, but I still think I still think equities are a good place to stay, particularly value. And the reason I say that is because we're not really, it's easy to forget that even with tapering and even with small interest rate increases, you're still looking at extremely accommodative monetary policy. You're looking at extremely supportive fiscal policy, although it's not really quite as supportive, but it's still in level terms highly supportive into the next few years. It's a good macro environment for risk assets overall. You'll see some volatility for sure, because you're not going to see a straight line path. You'll have to adjust to a world. These risk assets will have to adjust to a world where there's a little bit more two-way risk in terms of policy responses. But at the end of the day, it's still a very, very favorable macro environment. So I would be more cautious, but I would stick to a reasonable equity allocation here.
So if you're an equity bond cash asset allocator, you would still be overweight equities relative to bonds here?
Oh, for sure. I mean, it's hard to be overweight bonds here, right? When you're going to head into a period very likely of higher interest rates.
That's right, higher interest rates in response to higher inflation shocks.
Even if there's no inflation, interest rates are still going to go up a little bit, at least from here, right? Because just because you're not going to stay at zero forever, there's going to be a little bit of tapering, at least for financial froth reasons, if nothing else, real estate prices and so on as well. It's not just stocks.
Yeah. Well, okay. I think we're just in the last few minutes. We don't have any more questions. I was just checking on my phone for any questions, but I think that I think that as far as the developing world, so countries like Bangladesh and others, I think that they're maybe there's still, I think the major uncertainty there is less macro and more in terms of the Indian variant and COVID. So I think that the elephant, again, we say elephant in the room, or we're assuming with mass vaccinations that that the world is going to be, certainly in some developed countries that may be true, but we still have some uncertainty about this Indian variant, although I think it's called now, I've forgotten what there's some new Greek lettering now for these different variants. I'm not caught up with that, but anyway, the Indian variant. And then the less vaccinated parts of the world may drag on global recovery. And so we may see a much more varied global recovery, depending on who's been vaccinated and who hasn't in terms of different countries.
Yeah, for the rest of this year for sure, but I'd expect some convergence next year, though, right? But for the rest of this year for sure.
Yeah, depending on.
And we're seeing that already. Yeah.
Yeah. So I think we can wrap up. Again, I just wanted to thank you, Haseeb, for
thank you
your time.
for
I
having
think
me.
I think just in terms of concluding, let's say what can we conclude from this discussion? I think that I don't know. Maybe Haseeb, you can just make a 3-point summary. What would you say in terms of it sounds like what is your view on you're somewhat is it relaxed, or you're positive on financial markets? You're not yet hitting the panic button on inflation, and you think that central banks, it's that probably they'll have some leeway and some luxury for a few months yet.
I mean, I think that those are fair points. I'd add to that we are looking at a situation that I don't ever recall in my career, at least, which is there's a genuine risk that we could lose control of the inflation conversation and the actual inflation numbers. And when I say we, I mean central bankers here, really. It's possible, which is itself a massive statement, because I don't think we've actually quite seen a situation like this in many, many, many years. So my point was not to be complacent at all about this. If I sounded complacent, that was not the message. That was really not my message. The main point was that there are still issues. It's an uncertain world. And many of the things that kept inflation low are still in place, but there are new things that have emerged that suggest very significant upside risk. The question is, how long do you wait to address those?
Yeah, I think it's a fair point. And yeah, I think that maybe we can also conclude that in terms of generally the way that one looks at the global financial markets, maybe let's say just being bullish and relying on upward trending equity prices, or the kind of boom conditions we had in the last 6 to 12 months after the immediate turbulence. I think that trend of equity performance it'll be a much more uncertain environment in the financial markets with a lot more volatility.
Yeah, I think that we can say with quite a lot of conviction.
Yeah,
that path is unlikely to repeat itself. So.
Okay. Well, on that note, thanks again, Haseeb, for your time.
Thank you.
And we'll look forward to speaking to you again soon. Take care.
Likewise.
Great day. Bye-bye.
Bye.